Welcome to TheoTrade. This is Don Kaufman. Here we are. It's June 19th, 2016. It's Father's Day, doing the weekend update over here. All eyes this week are going to be focused predominantly, well, on really two major events that are coming back to back. I think most people are probably familiar with the first event, which of course is going to be the British referendum. Nevertheless, that's the British vote. Should I stay or should I go? We're going to find out this week. Oh, the excitement. I'm going to talk about the odds and the probability here in just a few minutes. But additionally, what can cause quite a bit of volatility and some heavy volume later this week as well, of course, is going to be the Russell rebalancing. See, now that's one that not everybody necessarily looks at over here. And if you do take a look at the Russell, in some of the recent trade, the volatility pretty extreme in the Russell. The next 5 days, the volatility is up to 27%. Now, is that the British referendum, or is that the fact that the Russell is going to be through some rebalancing? What you need to know about the Russell rebalancing, number one, it's coming on Friday. What do? They just kick some stocks out, bring some other stocks in. However, it's typically the heaviest volume in terms of stocks day of the entire year. But the fact of the matter is the Russell, well, this past 2 weeks has been in a little bit of a downward momentum, but so has the S&P. I mean, I'm not telling you anything you don't already know by looking at the S&Ps. We've had a little bit of a bout of volatility here. The question kind of looms with the British referendum. Were things a little bit oversold? Here's the bottom line. Forget about last week. Okay, forget about, what we saw in the VIX. What we want to know, okay, is ultimately what can occur this week. Forget about, this entire week you're going to be bombarded with media. This is what's going to happen. This is what's going to happen. The reality is you don't have a clue. Forget about even the British vote so much. See, the bottom line is that a tremendous amount of order flow and capital has already been moved, okay, pending, again, this British vote. It doesn't matter per se what you might think is going to occur. Right now, there's about a 30% probability of Britain leaving the EU, okay? But here's the reality of that, and I'm just contract adjusting, these futures over here just to get a better, cleaner look at the chart. And we're looking at the 30-year bond futures. The 30-year bond futures, they've seen this coming for quite some time. And as the probability of the EU leaving was rising, and then the probability all last week was all over the place. It was a 30%, got as high as like 42%. It doesn't matter what you, again, think about the vote or, what surprises we may see. The bottom line is this capital already made a drastic move, and the bonds appear to be in an extremely defensive position over here. And when I say it doesn't matter, listen, we may be shocked and, wow, that 30% chance, boom, all of a sudden, Britain does leave the EU, risk explodes over there. However, what's not to say that they vote, they stay, they're like, oh, I'm staying. Yeah? And risk has already ultimately exploded. You do not know how order flow is going to play out after some of the results come in, right? The unwinding of some of these defensive trades, like in bonds, can wreak havoc in terms of volatility on the marketplace. I am going to be displaying, okay, both bullish and bearish trades that you can take in this case, because, again, all the media and all the sentiment over there, it's going to be worthless to you. Cut the noise, forget about it. Literally, turn off your TV. It's not going to make a difference. Because in the end, it's all going to play out right here in the S&P futures and in the bond futures. That's it. And in the volatility, right? Every other stock on this screen is going to be impacted by what's going to go on this week. And when it comes to a week like this, where we have a major event, okay, and I wouldn't even necessarily call this a binary event. A binary event kind of means you got about a 50-50 chance, but this one, All right, it's not a 50-50 chance. However, there's been all of these defensive positions again placed, and it increases the risk drastically. Look no further than really two areas if you're trading throughout the course of this week or you're an investor. Number one, think about your risk. If you don't know what your risk is, let me tell you something. You're going to find out. Me, I go out and I beta weight my position to the spiders. If you're not familiar with beta weighting, we have a bunch of different demonstrations we've done here at TheoTrade on beta weighting. I'm short the equivalency of 5,382 spider shares. So I'm short, right? What do I want the market to do? Well, apparently I want the market to go down. Nevertheless, it's been doing that a little bit. A good couple of weeks over here, neither here nor there. I'm collecting some theta for that. But again, neither here nor there. All I'm saying is you better know what your risk is for this week. Okay? If you're worried right now about individual stocks, you're not seeing the big picture here. By the way, I brought up Google. And the reason I brought up Google here is this is exactly the kind of thing that I'm talking about is that, Google, no rhyme, no reason, no news, okay, falls, huge volume, all the way down to 700. Why is it falling? Well, the rest of the NASDAQ was roughly speaking getting smoked. Google just happened to be at the forefront of that. The market, again, this week, is going to be just that. It's going to be about the market. It's not going to be about individual stocks. Okay? And I know, again, people are going to be focusing and so forth on Google. Hey, I'll tell you what. I think Google breaks below 700. Doesn't matter. Doesn't matter, this, the British referendum. Google breaks below 700. So what? It means the NASDAQ is going down. Again, it's all about how order flow is going to play out this week. And prior to this vote on Thursday, I think we're going to see some fairly serious bouts of volatility. So, you gotta look at the market for what it is. And the reason I said forget about Google, because I know everybody in the media is going to be pointing out Google this and Google that. You know why I say forget about Google? I'll freeze the screen for just a moment here and I want to key into one very, very important area. Look at the 5-day expiration in Google. It has a volatility right now of about 28.9, all right? So it's like a $20 expected move. Well, heck, it did that on Friday. But neither here nor there. It has about a 29% volatility. So just keep that in mind for a second, a 29% volatility. This is important, okay? Now, take you to the next underlying. The XLF, what is it? It's the financials. Now, you want to talk about risk? This is why I said nothing matters this week but the risk on the table. The XLF, which is the entire financial sector, not an individual product, it has a volatility of 33%. That better catch your attention. Okay? The second largest sector inside of the S&P has a higher volatility than one individual product that's already seen substantial volatility. Meaning Google gets smoked the other day for almost 3%. Its volatility, hey, it's only like 29%. The XLF, it's been beaten up a little bit, but its volatility is seriously elevated. Now, in comparison, again, Google, forget about it. It's not where your risk is. The financials here are lit, right? And that's why I'm telling you, order flow, okay, it's going to be flying this week. So expect some sparks to fly. And I'm telling you that the volatility, you're going to continue to see it go up throughout the course of the week. It's not because volatility is really increasing. It's going to look like volatility is increasing, but options this week, they're not going to be decaying until after the British referendum. So number one rule on a week like this, number one, you don't sell options, okay? You don't sell options in the shortest duration expiration. They're not going to decay like you think they would, because what's going to happen? And everybody's like, no, they're going to decay. They're not going to decay. And I'm going to tell you exactly why. Decay is supposed to look like this. And it does. Here's an option trading for $1, and then it's trading for like 80 cents. Then it's trading all of a sudden for 55 cents. And they're like, oh no, it's trading for 20 and then 0. Well, guess what? Volatility this week is going to go up inversely proportional to decay. So what that's going to mean, as this volatility goes up, okay, what's it going to do? It's going to offset decay. So this week, decay isn't going to be, whoosh. Decay this week is going to be boop, like that, almost like an earnings announcement. You don't sell stuff before a major announcement, thinking that it's going to decay before the major announcement. And this week, again, we are going to be chock full of risk. So what you want to do is Monday, Tuesday, Wednesday, even like Thursday early in the day, you can actually be net long options. You can buy options and not have a huge amount of decay. As I said, they're probably not going to decay very much, meaning the expected moves. And if you take a look at a product like the spiders, okay, the expected moves over here is like $5 for the week. That's $5 move that you're going to get inside of the spiders. I like it. What do you think is going to happen? They're going to go up. They're going to go down, right? They're going to be all over the place. By the way, that also translates to the SPX. The SPX is expecting about a $50 expected move this week. Yeah, it's double. Oh, that's actually almost 2.5 times what we've seen recently. That's why I said, there is no rhyme, no reason. Like, people think they have an idea of what's going to happen this week. The market's telling you the exact opposite. It goes, you don't know nothing. You want to know why? Okay, I'll tell you why I don't know nothing. Because here's a 17% implied volatility. Okay, over here, it's 24% implied volatility. This one expires Wednesday. This one expires Friday. What are they doing? They're packing a ton of risk right into that British referendum there, giving us, all right, this big time expected move. The market wouldn't be anticipating this risk. And the risk, people are like, no, the VIX fell a little bit. Yeah, the VIX, though, is 30 days out. It looks at volatility for 30 days out. This is 5-day volatility. This is like the VIX over the next 5 days. It's like taking a temperature, okay, only in the next 5 days. And guess what? It's hot. It's really hot out there. And then again, the sector that worries me the most is the financials. And that's why I say order flow, it can go any way. Now, a couple of trades that you want to think about. All right. And I'm going to make these nice and easy and under control that anybody can obtain. Number one, if you're going to do a trade for the next 5 days, if you want to take a shot over here, well, we're trading right now in the spiders. Let me close up this left sidebar. We're trading in the spiders at 206.52. If you think we're going to rally, right? If you think we're going to rally, I'll delete a couple things out over here. You could buy the 205.5, 207.5 spread. There's a huge problem with this. Here's a $2 wide spread. Okay, 205.5, 207.5 for what? $1.19 debit. Yuck! Why do I don't like that? Because the 205.5s, they're $1 in the money, but they're charging you $1.19 for it. Why? There's this immense skew. The announcement is actually skewing the option chain much more than it has. So if you're looking at the spiders and you're thinking about doing a trade, the only trade in here is the bearish trade. If you buy a call spread this week, all right, the probabilities are just not there for you. I mean, you're risking $1.20 to be able to make $2. So the market is such that, well, it's kind of pricing in like, well, there could be the propensity to rally. But if you like the bearish trade, and again, this bearish trade, I'm actually going to delete the bullish trade and only look at the bearish trade right now. The bearish trade is trading for 82 cents. Now, the 207.5 puts, they're already in the money by $1. And you could buy the spread for 82 cents. You buy the spread for like 82 cents. You try to make about 55% of the 82 cents on it. So you would be exiting this trade in the neighborhood of like what? $1.30 to $1.40, somewhere in that neighborhood where you get in, you get out, you get on with your life. Okay, that's how you play this spread. And it's only for the next 5 days. What's the most you can lose? 82 cents. Okay. But the cool thing is if you make a decent down move at any point during this week, you might be able to exit this put spread. If you're bearish, exit the put spread prior to the British referendum even coming out. And I think we're going to see decent bouts of volatility on that. Now, that, ladies and gentlemen, happens to be your bearish trade. If you want your bullish trade, oh, it pains me to have to go to this product, the VXX. I've got no love for the VXX. I really don't. I don't particularly care for this product. But if you think that volatility is going to fall off, okay, which you very well may, don't get too cute. Just go out there and buy a put spread. Here's a 16-14 put spread for the next 5 days. Now, good, bad, or indifferent, okay, you're going to pay 98 cents for it, right? And what that says is, well, if the market rallies or if volatility just falls, to me, this is the way to actually look at a bullish trade in the S&Ps this week, is not to play it in the S&Ps, is to actually use the VXX. And again, I don't even like the VXX. All right, and I make no two ways about it. I don't particularly love this product, but it's a trade for the next 5 days. Volatility comes off. How can volatility come off? The market doesn't even necessarily have to rally. The market stays relatively flat this week, and volatility will come down big time. And as volatility comes down, this spread will get more and more profitable. Again, you want to make, if you're going to risk about $1 on it, you want to make in the neighborhood of 55-60%. So you're trying to make 55-60 cents if you do, again, the $2 wide spread for about a 98-cent debit. Now, last but definitely not least, throughout the course of the last, I don't know, few weeks in the marketplace, and I'll talk about this a little bit on Monday, Tuesday of this week, all you're hearing right now about this British referendum, and it's, hey, listen, we're finally here. This is the week. I mean, I'm excited about it because we've had some volatility coming in here. The bonds are going absolutely nuts. I mean, the bonds right now, how do you say this? And there's no other eloquent way to say this, but like the bonds, they're trading at like Armageddon levels. They really are. I mean, we're trading like 169 and change in the bonds. You know, the bonds look like it's the end of the world, and I'm screaming, yeah. Why? Because I'm short the market. But I just keep hearing about like odds and probabilities here, and I've had so many emails about it. So I'm just going to show this very, very quickly, and then I'm going to elaborate a little bit more over the next couple of days here at TheoTrade within our chat room. But one thing you got to know is right now, the odds on the leave, okay, and everybody's been asking me about this, the odds on the leave, what they basically are, okay, is 9, okay, to 4. And that means leave. Now, the 9 to 4, and the question that keeps coming up is everybody's like, how do you know that that's going to be about a 30% probability, sir? There's a very, very easy equation to take odds and to change it to probability. And here's the equation itself. So we're going to say probability, okay, equals B divided by, okay, A plus B, okay? And that's actually the equation. You're like, what the hell is A? What the hell is B? Well, okay, over here is A, and over here is B. So all you got to do is add these little monkeys together, right? What do you come out to? You're like, 9 plus 4 is 13, and then take B, all right, divided by 13, what does it come out to? And it comes out to about 30.77%. What do you got over there? About a 30% probability. So generally speaking, if you ever see like the odds out there, like 9 to 4, and it means about a 30% probability. So I just wanted to go through that really quick. And then that's on the leave vote, because it's kind of comical. I've seen a lot of media. They're like, yeah, the odds are like 9 to 4. And nobody even knows what that means without saying 30%. Clearly, they haven't figured out how to change the odds over into probabilities. Nevertheless, that's the quick and dirty way to do it. It's also really effective. The funny thing about this is this actually works the exact same way with like vertical spreads and trading, and that's exactly what I'm going to elaborate upon as the week progresses over here. So I'm serious about this. Stay tuned all this week. Okay, I'm going to be talking about odds, probabilities on these videos here. The right trades are about the right probabilities. It's not about what you think about a marketplace. Who cares? You know what? It doesn't matter what the media says. Well, Google's a very good company. Yeah, why is their stock down 3% in a day? It doesn't matter. Because what really matters over here is the volatility is even higher in the XLF than it is in Google right now. But the XLF didn't tank the other day, right? You got to know where the risk is and know where the probabilities will be most effective to play out. That's how you make money in today's efficient marketplace. Thanks everybody again for joining us here at TheoTrade. I'll be back on all this week. Have a great weekend. Bye-bye.